Já, kærar þakkir Ari, gríðarlega mikilvægt að kortleggja vel þennan stóra markað sem hefur svona mikil áhrif. Það komið að síðasta dagskrálið þessa morguns en við höfum fengið Simon McGeary, framkvæmdastjóra frá Citigroup til landsins. Kynningin hans mun fjallum hvaða áhrif kynningin hans mun fjallum hvað hefur áhrif á arðgreiðslugetu banka og fjármagnsskipan fjármálafyrirtækja í ljósi breytinga á alþjóðlegu regluverki fjármálafyrirtækja. Let me switch over to English. I would like to introduce Simon McGeary. Simon is a managing director and head of the capital strategy and structuring team at Citigroup. The capital strategy and structuring team is involved in originating, structuring, and executing hybrid capital and other structured fixed income transactions for banks, insurers, and corporates. It also advises issuers on capital structure and the debt market, consequences of broader regulatory developments, such as bank resolution and bail-in. As well as this works with issuers, the team maintains a broad range of dialogues with regulators, policymakers, and investors. Simon joined Citigroup in the year 1993 and has held a number of positions in debt capital markets products and coverage, with a particular focus since 1998 on hybrid capital. Simon holds a master's degree in engineering, economics, and management from the University College, Oxford. Simon, the floor is yours.
Good morning, and it's a pleasure to be here. Today I'm going to talk about capital management, how European banks are approaching their management of capital and looking at the context for Icelandic banks as well. So if we perhaps start just with a little look at how the regulatory capital framework has developed over the last few years. We have on the left here the pre-crisis framework, so sort of back pre-2011. So banks used to need to hold about 8% of so-called total capital. This is set as a percentage of risk-weighted assets. So perhaps just to explain what that is, if you have a loan for 100, regulators or banks assign some sort of risk weight to that to reflect how risky the instrument is. So if you have a 50% risk weight, then 100 of loan shows up as 50 in your risk-weighted assets. So yeah, banks had to hold 8% of capital against those risk weights. As you can see from here, roughly half of that was in so-called Tier 2 capital, which is subordinated debt. And then the other half, down the bottom here, in higher quality Tier 1 capital. So that includes common equity down here, and then preference shares, preferred equity, and hybrid Tier 1, which is somewhere in between debt and equity. So that was the sort of picture overall, but I think sort of perhaps importantly versus what we'll look at in a minute, the amount of common equity was relatively low within all of that. So what does the new world look like? Well, we're sort of towards the end of a phase-in process. This is the so-called Basel III or CRD IV. It phases in from 2013 through to 2019. We start with Pillar 1, which is this bit here, which doesn't look a million miles different to the bit on the left. There's perhaps a bit more equity. Common equity Tier 1 or CET1 is a term I'll be using a fair bit over the next few slides. And then you have a Tier 1 capital requirement of 6%, which can comprise equity and additional Tier 1, so more of the hybrid type instruments, and then a total capital ratio under Pillar 1 of 8%, which includes a smaller subordinated debt Tier 2 piece as well. But that's not the end of the story. So on top of that comes Pillar 2, and Pillar 2 is probably best described as all of the other bits that aren't captured by Pillar 1. So that's up to the regulator to set based on what they think that the bank is running in terms of risks. Depending upon which country you're in, that either has to be met fully with common equity Tier 1, or in some places like Iceland, the UK, Sweden, for example, you can still hold a mix of these other instruments. Then on top of that, you have what's known as the capital conservation buffer. So the capital conservation buffer is a sort of pot of equity, if you like, that you can dip into in times of real stress. However, there are significant constraints on how a bank can operate its business and what it can pay out in terms of dividends and other discretionary payments. So under normal circumstances, any bank would choose to operate comfortably above that. Then on top of that, we have systemic buffers. So these can take a number of forms. You can have a systemic risk buffer, which is typically when the size of the banking system relative to the national economy is large. And you can have systemically important banks as well. So the so-called GSIBs, which are the globally systemically important banks, or DSIBs of banks which are big in terms of their domestic economy. In Iceland's case, you have both of these buffers on top as well. Then, still going, we have the counter-cyclical capital buffer. So that's designed to sort of stop an economy overheating. So if, for example, a mortgage market is getting hot and house prices are going up, then you might end up with a counter-cyclical buffer being imposed. And the idea is that by imposing more capital requirements, making it more expensive to lend, that sort of slightly reins the banks back in a bit and cools down the economy. And Iceland's countercyclical buffer went up to 1.25% at the start of November. And then finally, if all of that wasn't enough, to the extent that these various buffers are not enough to protect banks against stress tests, so you perhaps know nowadays banks are subject to stress tests, so they have to model downturn scenarios and make sure that they can survive those. So if the impact of the stress test is bigger than this buffer, and this buffer, then you get a sort of an extra buffer on top, known as, depending on where you are, either Pillar 2G or Pillar 2B, but it's basically an extra buffer just to make sure that the stress test can be withstood. So when we sort of put all of that together, and then you can compare this side, and in particular the size of this bar versus this one, you can see how the picture has changed for the banking sector over the last few years. This one perhaps a little bit harder to see, but hopefully you can make some of this out and recognise some of the logos. So where are we today? Well, the Icelandic banks sitting up here start in a very strong position, as you can see, sort of looking down versus the capital ratios of European peers. But that's not actually even the whole story, because banks calculate these ratios in different ways. The Icelandic banks use what's known as the standardized approach, which is where the risk weights are set by the regulator, and these are fairly conservatively set. Other banks use what's known as an internal models approach, and so they, within certain limitations, get to assess what their own risks are and set their own risk rates as a result. And perhaps an example of that is in Sweden, where a residential mortgage, a reasonable residential mortgage for a Swedish bank would typically be something like 8 or 9% risk weight, versus the number that the Icelandic banks use under the standardized approach of 35%. So obviously a significant difference there. Now, that does get caught elsewhere. You'll see these numbers, which is the Pillar 2 bit, are pretty large for Swedish banks. So the regulators set what's known as a mortgage risk weight floor for them, which brings that 8 or 9% up to 25, but still lower than the 35 that the Icelandic banks have. So effectively, if you're not comparing apples with apples, if you're looking at an Icelandic bank's ratio versus a Swedish bank's ratio, because the Swedish banks have a lower risk weight number and then a higher capital requirement on that, the Icelandic banks just have a bigger number to start with and a high percentage on that as well. Then I talked about the systemic buffers, the fact that the Icelandics have both the systemic buffer and the DSIB buffers for the banks themselves. So that's roughly 3% for the systemic buffer and then 2% for the systemically important banks on top of that. And then quite interesting, when you put all of that together, there's another measure that the regulators use called a leverage ratio. And the leverage ratio is a sort of simplistic backstop, so that does away with all of the risk weights that I talked about just now. So it treats a loan to a government, a loan to a farmer, a loan to a multinational company, a mortgage, all in the same way. It doesn't adjust it at all for the risk in there, but it's a very sort of simplistic way, if everything completely melts down, of assessing what the bank's leverage is. So the international standard for that is 3%. Most European banks operate around 4%. But as you can see, the Icelandic banks are in the sort of mid to high teens, which reflects those two conservative aspects of the capital calculation that I already described. If we look at how banks have actually improved their ratios over the last few years, these are some numbers from the Basel Committee's monitoring report. So it looks at 200 or so banks globally. You can see a sort of steady rebuild of capital over the last few years. Interestingly, though, when you sort of break that down, there's a mixture of the dark blue, which is actual capital raising and retention, and then you've got the sort of light blue bit here, which is risk weight growth. So you can see in some years banks have actually been shrinking their balance sheets to improve their ratios, as well as raising capital. Remember this number at sort of 15% as an average number versus the Icelandic banks at mid-20s or so, and that's, again, without adjusting for the standardized calculation of risk weights. Down the bottom, we just look at sort of a breakdown by regions. We've got Europe as the dark blue, the Americas as the sort of grey blue, and the rest of the world as the light blue. You'll see there's a few sort of differences here, notably on the leverage ratio. There are some structural differences across banking systems. A good example of that is that in the US, most mortgages are held by mortgage agencies. They're not actually held on the balance sheets of banks. So that, again, means that there isn't a sort of completely equal comparison from one country to another, and that's sort of one of the reasons why the European leverage ratio is lower. So have we done enough? Are we there yet? Well, this chart shows the current CET1 position along the bottom here, and then the buffer to the end state requirement there. And again, you can see where the Icelandic banks are sitting. You can see the sort of neighbours up here are the Swedes, Danes, Norwegians. Again, that's not a completely equal comparison because of the way the Pillar 2 requirements are applied in those countries. And if you actually took those into account, those banks would be much more down in the pack here. But again, you can see the sort of relative positions there. But banks are still sitting on some excess capital as they try and adjust to further items on the regulatory agenda. The ones I'd probably highlight are the so-called Basel IV. That is a sort of fundamental rewrite of how some types of risk weights are calculated, and in particular for the banks that use models, there's what's known as a model-based floor to that. So that will particularly impact those banks that have low risk-weighted assets. So the ones that are quite nervous about that are the likes of the Swedes, the Dutch, the UK, and so on. Then there's something called IFRS 9, which is an accounting measure. That's basically how quickly banks recognise bad loans, amongst other things. There's model review. So the ECB is undertaking a massive exercise to make sure that where banks use models, they're using consistent assumptions and people aren't being too aggressive in terms of how they calculate those numbers. So I wouldn't expect a big average impact, but there might be some significant impacts for individual banks around that. There's non-performing exposures, so bad loans. This is particularly something relevant to the Italian banks, as you might see in the press from time to time. Stress tests, as I mentioned, I think are being ratcheted up. With the banking sector now being stronger, arguably the regulators can come up with a more stressful stress test, which they are doing. And then banking union within the Eurozone, and there's some political discussions going on about how to fix some of the legacy issues before they start pooling their national resources. But as banks start to think about optimising their capital structure, you've got a few banks still rebuilding, but I'd say most are now in a situation where when they get a bit of clarity on some of those other points, they can start to optimise. So what does an optimal capital structure look like? So step one is to make sure that you've got enough equity, the Common Equity Tier 1, and remembering how much bigger that bar has got over the last few years. So you want, versus your requirement, you want enough equity and a comfortable buffer on top. So all else being equal, a bank with this bit would look fine on an equity point of view. Again, though, that's not the full picture, because if you remember, they also have to meet a separate Tier 1 requirement, which can be filled with either more equity or additional Tier 1. And then they have to meet the total capital requirement on that, which again can be met with any of these higher quality elements, but can also be met with the subordinated debt. So if we look at our sort of fully fledged capital stack with all of those bits in it, this is our bank on the left-hand side, which has got enough equity. It's also got these bits filled as well. The analogy I tend to use for this is imagine a sort of bucket of water, and equity is the water. If you drop a stone into it, the water level goes up. If you take the stone out, the water level drops down again. So think of the Tier 1 and the Tier 2 as the stones, and think of the equity as the water level. So if we were to remove our stones, then suddenly the equity drops down, and what was a comfortable position and what did exceed the requirement now doesn't anymore, and the bank actually has a shortfall, and it's operating in this sort of uncomfortable zone where it's subject to various restrictions. So that's the way to sort of think about how you can use the different instruments to meet the requirements in the most efficient way. At the same time, now is a good time for banks to be raising capital. These two charts are the cost of Tier 2 capital here and the cost of Tier 1 capital there, and you can see that those costs have come down substantially over recent years. I think it's important to make clear that these are not normal market conditions that we're in at the moment. Markets everywhere around the world are being propped up by all sorts of elements of central bank liquidity. Investors are in what's often described as a hunt for yield in a low interest rate environment. Bank capital itself is not eligible to be bought by the central banks in these various bond buying schemes that they have, but when you have corporate bonds quite literally going to zero, investors are left trying to figure out what's left that has any sort of yield, and so that has a knock-on effect and helps to explain part of this strong rally in these instruments here. I talked a bit about management buffers in terms of thinking about what's the right amount of equity. So if I sort of think about what are the main drivers of that. So first one is earnings power. So if you have strong and stable earnings, that acts as the first line of defence, and everything else is sort of generally okay after that. You need to think, what's the business mix and the volatility of the bank's business? Is it a bank that's predominantly focused on retail or corporate banking, or is it a big investment bank with big trading operations that can be more volatile? What's its planned rate of growth? Does it need to hold a cushion of equity to help it expand the balance sheet and help extend more loans? How exposed is it to movements in foreign exchange rates? Obviously something that the Icelandic banks need to contend with. The risk weight density, which is another way of saying how conservative are the risk weights. Again, if you have more conservative risk weights, these will tend to be less volatile over time, and perhaps you need a lesser buffer as a result. The anticipated regulatory changes that I talked about just now, the impact of stress tests, and then there's perhaps one or two other ones I might sort of just mention as well that I didn't put on the slide. But one is the size of the bank. Is it a small boat on a large sea, or the other one is its ownership structure. And interestingly, some of you might have seen that recently Nykredit in Denmark decided that it wouldn't move ahead with an IPO as it was planning. And they put out an interesting statement recently saying that as a result of that, the Danish FSA was going to make them hold 0.5% more capital than they would have done otherwise, basically because they sort of think that their access to capital, if they need it in a stress situation, is not quite as good as it would have been if they'd actually floated on the stock exchange. If we look at sort of where are banks in terms of the management buffer, which is the dark blue bit, and then earnings sitting on top. Earnings as the first line of defence is about 1% on average, or if you cut out the loss-making ones, about 1.5%. And then the buffers average about 1.8% at the moment, but I'd expect that perhaps to come down a little bit once we've got clarity on some of those other regulatory developments that I talked about just now. The other thing that the banks need to manage is the rating agency view. The rating agencies have their own different definitions, calculations and ratios in terms of looking at banks' capital, but it's sort of based on a similar sort of process of looking at what's the amount of capital available and what's the actual riskiness of the balance sheet overall. Again, the Icelandic banks come out very strong here. So S&P has various thresholds that it sort of puts banks into different buckets. So even after the planned capital efficiency measures that the Icelandic banks are undertaking, the plan is still to remain in that high bucket there. And also just worth thinking about what goes into those metrics. So Tier 1, for example, goes into that. Tier 2 doesn't. So again, that's something that plays into how banks think about optimizing the capital structure. Another question that arises is that with all of this extra capital, can banks still actually operate properly as businesses, and can they make a reasonable return on those increased capital levels? Now, this isn't just a shareholder question, it's also a question for regulators and rating agencies as well, because a profitable bank is a healthy bank, and as mentioned before, earnings are the thing that acts as the first line of defence in terms of absorbing any losses. So here we're looking at capital position and we're looking at returns up here. I think it's fair to say that the picture is mixed at the moment. There are some banks that are still struggling down in this sort of lower corner here. There are probably around Europe a few business models that are fundamentally broken and a few sectors which are structurally unprofitable, but the good news there is that even with these higher capital levels, the Icelandic banks still look reasonably good against the overall European peer group, and of course this is on a much higher capital base, so over time we probably expect a movement in that kind of direction as the capital gets made more efficient, and then the returns can improve a little bit as well on that. You might think that that's sort of the whole picture, but sadly not. There's other things that we have to look at as well. So we've looked at the capital requirements, but there are also very big changes underway in terms of how governments and regulators deal with failing banks. So we're moving from a situation of the previous government bailouts to what's known as investor bail-in. So really what that means is that if a bank gets itself into difficulties, it needs to be able to recapitalise itself out of its own debt. So think of it almost like a sort of traditional debt for equity swap for a company. So we start with our sort of new world capital structure here that I talked about before, but you can see that I've changed the scale of it this time, so you can probably guess what's coming in a minute. The way the bail-in numbers, and you'll hear terms sometimes like MREL and TLAC for these things, but they're both broadly the same thing, which is this amount of recapitalisation debt. So regulators apply what's known as a two tanks approach. So the idea is that you can lose your current capital base once, but then you need the same again sitting on top in terms of bail-inable debt, so that once you've lost this bit, you can replace it out of this stuff here, and then you still need to have your buffers sitting on top of that as well. So again, not only do we have the much enlarged capital requirement, but then you've got to sort of getting on for twice as much again in terms of debt, so that the bank can recapitalise itself if that's required. Now, there is a very valid debate which may be had in Iceland in due course as you think through these issues about if you already have a very conservative capital structure, surely that makes the bank safer in the first place, and surely that means that the chances are that you don't lose all of that capital if you get into difficulties. Therefore, do you really need twice everything to recapitalise? They had that similar debate in Sweden, quite an interesting public debate going on between the regulator and the Swedish Debt Office on this. But they have sort of broadly ended up in that situation as well in the end. But that obviously has implications in terms of the cost of banks' debt, because this bit becomes a bit riskier than it was, albeit supported by these much thicker capital layers sitting underneath. Another one that's perhaps a little bit hard to read, but the kind of punchline is this number here. So when we look at what's the remaining requirement for European banks to raise this MREL debt, the bail-inable debt, there's about 300 billion euros remaining, which needs to be filled by 2022. So far, so good, I think, in terms of how the market has received these new types of instruments, and again, in an environment where investors have been looking for anywhere to pick up incremental yield. These instruments have been quite attractive. The dark blue bits here are the shortfalls for the banks, and then the sort of grey blue bits on top are the refinancing needs that they have over time as well. So markets are going to remain busy, and it's obviously important for Icelandic banks in terms of thinking about their international funding programs, to think about what the competition is for funding out there. So I'll finish with the banking sector outlook. We've got the sunny side in terms of the recapitalisation of the banking sector being broadly complete. Banks are supporting growth in economies now, and then that leads to a sort of virtuous circle between these two areas, that as banks support growth and recoveries accelerate and interest rates start to rise, that's actually good for the banks themselves. So that's a sort of reinforcing dynamic there. And then, as I mentioned, as we get greater clarity on a number of those outstanding pieces of the jigsaw puzzle, then banks can start to plan their capital optimization. There are a few clouds still around. Ironically, the clouds are probably in the sunnier parts of Europe in particular. But there's still some question mark over profitability and whether some banks can make a sustainable return. There are still some legacy bad loans to be cleared up, as I say, in particular in places like Italy. And in due course, there's going to be the wind down of the various central bank liquidity schemes, which has, depending on where you look around Europe, been something that's been supporting the banks. But the good news is that the Icelandic banks are pretty much over this side. Obviously, you've been on quite a journey over the past decade, but you've got to a good place now. We've been delighted to play a small part in helping you along the way, and look forward to continuing to do so. So that's it. Thank you.
Thank you, Simon, for an informative presentation and for simplifying a very complex matter. Við erum að ná að klára á réttum tíma, en þið vitið að það dýrmætasta sem við eigum tíminn, þannig að ég er mjög stolt af því að við séum hérna á réttum tíma. Ég vil þakka ykkur kærlega fyrir komuna til okkar í dag og vona að þið hafi haft gagn af því sem hér hefur komið fram, að þetta hjálpi ykkur við að skipuleggja framtíðina. Þetta var mikið efni og við munum birta það allt saman á umræðuvefnum okkar. Ég hvet ykkur til þess að kynna ykkur vel umræðuvefinn. Þar verða allar kynningar og líka mikið af öðru gagnlegu efni. Við gefum einmitt skýrsluna okkar út núna í fyrsta sinn bara rafrænt. Það verður að spara pappírinn. Mér langar til þess að nota tækifærið og lokus á því að óska næstu ríkisstjórn velfarnaðar og að óska þess að það verði náð að halda þeim stöðugleika sem hér ríkir. Ég veit að við bíðum öll mjög spennt eftir fréttum úr þeim ranni. Ég segi fundi slitið og þakka ykkur fyrir. Takk.